than your currency. Splurging millions, buying houses like Monopoly. Fucking 9 to 5, man, the money is a joke to me. Buying cryptocurrency, my money in the privacy.
Hey guys and girls, welcome to this week's episode of the No BS With Birchy podcast. I'm your host, Nathan Birch, and this is the show unraveling the truth to the facade of the 21st century. We're now exiting the matrix and waking up to motherfucking reality. Today, I want to talk about something very important that I don't think a lot of people actually touch base on. And it's all going to be related to property stuff today. And I'm going to be talking about exit strategies. Everyone seems to like to talk to me about, buying strategies, how to buy a property, how to locate the property, how to negotiate the property, all of those sort of things that we cover off on a regular basis. But the thing that we never talk about is the exit strategy. So selling down properties, how to minimize tax, how to, what is the plan, what is the strategy? And I think a lot of people fail to address these sort of topics when they're trying to buy the property. They're always thinking about today, but they're not thinking about, 5, 10, 15, 20, 30 years down the track. And that's where a lot of people get stuck. So looking at it, there's lots of things on cover on topics today. I've got a lot of little notes here that just to prompt me on little things that I want to talk about. But a lot of people, in their planning, they're like, I want to buy a property, I want to sell a property, I want to buy a property in this location, I want to buy a house, I want to buy, they're focusing too much specifically on the property, but they're not thinking about, the overall strategy, and they're not thinking about, the end goal of how it's going to help them into retirement and see them through that time. So you've got to ask yourself, do you buy it under your personal name? Do you buy it under a trust? A lot of people want to just opt for a trust, but when they buy under a trust, there's a lot of negativity around buying it under a trust as well. So it's very important to get the right guidance at the start as to, is the property best to be purchased under your personal name, or best to be purchased under a trust, or is it best to be purchased under a super fund? And there's all different sort of vehicles in order to be able to help you, hold that asset over the years. Probably the largest portfolios that I see out there, people don't generally get a trust until they get to about 10, 15, 20 properties in their portfolio. Then they start looking at trusts. But as always, I'm not a financial advisor, my little disclaimer in there, but I'm also not a tax advisor. If you need help, you can reach out to my team and speak to my team at One Path Accountants and see what they have to say on that front. Be careful, because a lot of accountants out there will try and sell you a trust just for the exercise, because they get paid a lot more fees. Generally, when I do strategy sessions with my investors, I'd probably say a percentage of my investors, maybe half of them would be first-time investors, and the other half would be an investor that's got 1 or 2 or 3 properties. Some have 10 or 20 in their portfolio when they come to me. And I can generally tell, at their position, if someone's come to me and they're like, Nathan, I've got 5 properties and I'm stuck, or I've got 2 properties and I'm stuck, I can generally tell just from having, my map form filled out as to who their advisor, like whether it be the lawyer, the accountant, the financial planner, or their finance sort of broker, who has actually, or the person giving them the properties in their portfolio, who has actually screwed them up with the wrong advice. So it's very important to make sure that your strategy is going to last, for intergenerational. What a lot of people don't realise as well is the debt. When they're collecting these properties, they don't look at the debt and think, okay, this loan product needs to be structured correctly to outlive me when I'm not working. So, for example, if you're buying, 10 properties in your portfolio or 20 properties in your portfolio, your goal might be to finish work in 10 years' time or 5 years' time. But if the loan is for 30 years, how are you going to be able to service that debt when you're not working? How are you going to be able to, what is the strategy behind this? How are you going to, pay out that debt and retire that debt? So a lot of things come into play, and I think it's very important to look at the big picture. If you're thinking of a trust, right? Just if we go back to the trust, I'm not a big fan of them. I have a lot of them, but my position's different than someone starting out. I didn't have a trust until I got to about 20, 30 properties to start off with. And I look at a trust, and a lot of people don't think about it, but like you could be holding $3-4 million worth of property in a trust today, but then in 10 years' time, that property portfolio in the trust could go to $10 million or $20 million. So, how do you disperse? How do you sell off? What is your exit plan? So looking at what type of exit strategies there are, right? So first one is planning and getting that strategy right. Second one is, I see so many people coming to me and they're like, Nathan, I want to buy a house and sell it. I want to buy, renovate and flip it, whatever the case may be. Always go back to the fact that I've been doing this for 14 years now. I think 14 years, I don't know, I'm losing my mind now, it's getting that long. I think it's 13, 14 years. And I've never had anyone come back to me or at any point and say, hey Nathan, I'm so glad I sold a property 10 years ago. I'm so happy I sold a property 5 years ago. The general things people come to me with is, I wish I bought more properties. I wish I didn't sell my properties. And, if you bought a property for 300 grand in 2010 and sold it for 400 grand a year later in 2011, you would have felt so great back in 2011 because you just made $100,000 and it was a lot of money back then. But you look back now and you think, okay, that property's now $1 million and it's impossible for me to be able to go and purchase that property again. So it's very, very important to work out, do you need to buy a property that you're going to be flipping, or you're going to be buying a property that you're going to be buying and holding for the long period of time? How's it going to fit in your portfolio? So buying and selling properties and flipping properties is not something that I do. It's not my game, but I have occasionally sold a property here and there if I needed to, or if it's been more of an admin issue more than anything. So looking at the portfolio and all those properties that I have sold over the years, I've looked back and I'm like, shit, if I didn't sell them, what would it be worth now? Looking at your strategy, how are you going to get to your end goal? So let's break it down a step. So do you want 50 grand a year passive? Do you want 100 grand a year passive? Do you want a 10 mil net worth? Do you want 200 grand a year passive? Whatever it is, you need to have that end goal in mind from the start. So your exit strategy should just be as important as your purchasing strategy and your acquisition strategy. So very important to think of your exit strategy at the start when you're actually doing the purchasing, because if you're wanting to get $100,000 a year income coming through, then you need to work backwards. That's $2,000 per week. If the average property is renting for $300 per week, then you're going to need about 7 properties owned outright to get to $2,000 per week. So one goal would be to get to 7 properties, work hard, pay them off. But then what would be the point in working really hard, being extorted from the state, having to pay 30%, 40%, whatever in tax, and then taking that retained funds, paying out debt, which is only 2 or 3% worth of interest, where your inflation is much higher than that. So that would be a bit of a slow strategy. A second option could be that you buy 14 properties and those properties double in value. You sell off 7 of them when they double and use the profit from those 7 to pay out the loan on the other 7, thus meaning that you've got 7 properties unencumbered. Or the third option could be that you just have 14 properties and then those properties bring in $100 a week positive cash flow, $150 per week positive cash flow, and you keep the debt on it, you don't retire that debt, and ultimately just keep that debt attached to the properties for the next 20, 30 years as those properties pay themselves down. So looking at the exit strategy, are you going to be in a position that you want to sell the properties? How many properties will you need to own if you are going to sell some to pay down debt? What about capital gains taxes? For me, if we look at those 3 strategies, the initial one was to buy a lot of properties. It was to buy 10 was my goal, and then to work hard and pay them down. But then I thought about having to pay tax and then didn't know about inflation, didn't think about selling things down. That's a very safe strategy, but it's also a very slow and counterproductive strategy. Looking at my strategy today, it is just to buy as many assets as I can, watch the money become worthless, watch more cash flow come through in my bank account every week, and then utilize that new cash flow via rent increases and whatnot to pay down the debt, retire the debt, and then pay out those loans over the next 20, 30 years. So it's important to think about, are you buying the properties to sell? Are you buying the properties to keep? People talk about buying properties to develop, which is a good strategy. I have done that myself. I've bought some, subdivided them, done whatnot, sold them off. But the important thing to look at is, once again, if you're going to be selling that property, you're going to be triggering capital gains tax. You're going to be losing that asset, so it won't be in your portfolio anymore. You will not see any further capital growth. You will not see any further cash flow coming into your bank account week after week, and you'll be losing of an asset. So, it's very, very important to work out. I see people, wanting to be an investor, but they become more of a speculator. And I see a lot of people that want to become investors, but they're becoming a very active investor. So if you go out today and buy a property, you could be buying a property for, $500,000, and that property, you sell it for, $800,000. You split the block in half, let's just assume, and you make yourself $300,000. It might seem very good today to go and make $300,000. There's no problem taking a profit. But the problem is that when you go back to buy the next property, if you're paying $700,000, $800,000 for the next property, you haven't really made anything because you've had to jump back in the market. So I see people buying these assets and then they sell them, they make a profit, pay out the agent, the stamp duty, the capital gains tax, everyone gets paid, they get a little bit of money, and then they have to go do it all over again. At the end of the day, the money is losing its value as well. It's not buying what it could beforehand. So the more important strategy when I look at investors and all our investors in the community is buying as many assets as we can physically afford and watching the cash flow come into the bank account, the cash flow getting inflated, and the asset value getting inflated. You want to be minimizing risk at every step along the way, because if you could sell off a property, I look at my portfolio today and think, I could have paid down some of my debt 10 years ago, been very happy. I could have paid down debt 5 years ago, been extremely happy. I could pay down my debt today. But the difference is that, let's say that for every 10 properties going back 5 years ago, I might have had to sell off 3 to pay out 7. 10 years ago, for every 10 properties I had, I might have had to sell 5 of the properties off to pay out the other 5. But today in my portfolio, I might only have to sell 1 property to pay out the other 9 properties out of 10. So the more that time goes by, the more the assets are getting inflated, the more the currency is losing its value. It becomes easier and easier to retire that debt. So you want to be thinking, as far as your exit strategy goes, you want to be thinking that very much so at the start. But throwing another element to it, you want to be thinking about your debt strategy. A lot of people will just go, okay, I'm going to quit my job today and I'm going to live on my rental property. I'm going to sell a property, I'm going to take some profit, and I'm going to live off that cash. Problem is that if you're selling a property, living off that cash is going to run out one day, and how are you going to replenish money into your position? The second thing is, if you're going to be quitting your job, your cash flow is great, everything's fine, what happens if something goes wrong? Have you thought about that loan product that you've got? Have you thought about how that loan is going to perform in 3 years' time, 5 years' time, 10 years' time, and 20 years' time? Have you got a fixed mortgage that in 5 years' time comes off being fixed and goes to variable? Is there a risk associated to that? Have you got an interest-only loan today that could go to a principal and interest loan in 2 years or 5 years' time? What is your ability if you got stuck? How would you be able to get access to equity? I see so many people not thinking about their loan, quitting their job, retiring from the workforce, and then going, shit, I can't do anything with my loan. So I think as a part of building up your exit strategy and thinking about the later part of your portfolio, before you change your financial position in any great detail, you want to make sure that your loan product is going to be able to survive and last you for 20, 30 years in retirement, because you can't go back. If you've got no job, you ain't getting a loan. So looking at that loan product doesn't mean that you could refinance to a cheaper loan product before you plan to exit the workforce. Does it mean that that you could pull out all the equity? I see so many people that have lost their job in the last 2 years, haven't thought about it before they quit their job. They may not have wanted to have a medical procedure, and then they go, well, I'm going to quit my job, and then they are stuck in a position where they have no options. You might have millions of dollars worth of equity in your property. I know when I quit my job, I went and tried to pull out as much equity as I could and had that sitting in an offset account, so then I could utilize that funds as much as I want, because it's in an offset account and it's already been set up. These things are very, very important to think about and to plan for your exit strategy. For me, as I said beforehand, I'm not a big fan of selling, but when I'm buying a property, always think about if I had to sell this, if something went wrong, the sky fell in, market completely shit itself, aliens invaded Earth, whatever the case may be, what would be my exit strategy and how could I protect myself? And I always think that's why I came up with the strategy of the 3 things when I first started investing, which is obviously buying below market value, because if you're buying it below market value, you're buying a property for 200 where it's worth 250,000, that's 20% below market. If the market falls by 20%, then you'd be losing money. But if it'd take a lot for the market to fall by 20%, I've certainly seen in all markets, even blue chip markets in Sydney and Melbourne and Perth and Brisbane and all capital cities, I've seen over the last 20 years, the times when those markets have come back, all of them by about 20% at some point of time. If the market turned to shit and you had to sell that property off, if you're buying at 20% below market value to start off with, well then you've got a buffer in place. So you know that the market really has to get damaged before you start getting hurt. So making sure you're buying it below market value is crucial. Making sure that it has upside for capital growth. I see so many people today adding risk to their portfolio. And what I mean by that is that if you are buying a property in 2021, 2022, 2023 even, we're not even there yet, we're only at the start of 2022. If we're looking at a market that's doubled, a lot of people go, I want to buy this market because it's moving, it's very hot, it's a very good market. When a market has shifted, you're buying in at the top. If you're buying in at the bottom of a market, the downside risk is removed. When you're buying in a hot market or a moving market, there's a lot more downside risk that's there. So for me, I'm a contrarian investor, so I'm trying to remove risk. So I want to make sure that there's a lot of upside. If you're buying a house in Sydney with no eaves on it for $1.5 million on a 250 square metre block, and it's never been that price before, and the question I always ask is, how could this property go from 1.5 to $3 million? Does the market allow for that to happen? For that thing to double, a lot of things need to change. Interest rates would probably have to fall by about 70% of where they are today. You would have to see wage increases, and you'd have to see deflation on consumer goods, where we're seeing inflation, we're seeing no wage movement, and we're not seeing interest rates move, and we're almost at 0 interest rates anyway. So there's not much there to give for that market to take off. But if we're looking at a market where we're finding a property which might be $250,000, and the average person would have to get a loan of 200 grand to buy one of these properties, A, the ability for them to put a smaller deposit down is great. B, you've got a smaller deposit on the property, but with a $200,000 loan and a 3% interest rate, that's only $6,000 per year. $6,000 per year in interest at 52 weeks, that's $120 per week. Everybody could afford $120 per week on paying the interest on a $200,000 mortgage. The difference between a $200,000 mortgage and a $1.5 million mortgage is very, very different. The chance of that mortgage the chance of the property going up from $250,000 to $500,000, even if the market went up to $500,000, let's assume that someone got a 100% loan on that, that would still only be $15,000 per year at a 3% interest, or about $300 per week worth of interest to keep that property, which would be less than the rent in that area. So when I'm looking at assets, I'm trying to remove that risk by buying them below market value, looking for the upside from growth, making sure that the strong cash flow, when I say strong cash flow, ideally positive, fairly neutral, but not too far negative, because I'm buying the property to look after itself. I want it to have its own heart, lungs, and respiratory system for the property to be self-sufficient. The thing that I thought about probably over the last, more specifically in the last 24 months, is buying properties which would cost more to rebuild the actual asset, because we're in a world now where massive inflation is coming through. For there to be any sort of, there'll become a point where we see a pent-up demand where people will want to be moving into all these markets, whether it be from natural growth in the country, whether it be from immigration laws changing, whatever. And we're going to see a pent-up demand, people moving into these properties, but unless the prices moved dramatically, then it wouldn't be profitable for a developer to build a new asset. We want to see that spill over into these markets of existing properties. If you can buy the property cheaper than what it costs to rebuild it, then you're building a buffer in place and helping yourself with your exit strategy to be able to get out of the deal. You need to work out, really at the start, what is the end game? I think once you get to 10, 15 properties in your portfolio, then you can sort of reverse engineer that and go, okay, am I at a point where I could sell off a couple of my properties? Am I at a point where I want to sell off more properties? If I was to sell off my properties, what would my portfolio look like? If I was to sell off my properties and the market was to double again in the next 5 to 10 years, what would I feel? How would it look like? And these are the sort of things to question, because a lot of people are looking too far in the moment, but they're not looking at the longer picture. And for me, my thoughts is, if you're not looking at owning an asset for more than 5, 10, 15, 20 years, you're just speculating, you're just gambling. When I'm buying an asset, I'm looking at, okay, this is a great asset, whatever it is. Ideally, in this situation, we're talking about property. I want to make sure that that asset's going to be a part of my portfolio for the next 10, 15, 20 years. If I was to lose that asset, how would that impact the overall strategy and performance of my portfolio and ultimately affect my lifestyle or my retirement? And that's what I think everybody should be thinking about when they're buying an asset is this a long-term strategy? Am I going to be regretting this? Is there an opportunity cost? Like, people going out today, you might have $100,000 going, okay, I'm going to buy a property, I'm going to buy it, renovate it and sell it, and I'm going to get some more cash, and I'm going to do the process again, buy, renovate and sell it and make even more cash and have a big pile of cash there. There's nothing wrong stacking cash, but the problem is that if you had $100,000 at the start of 2020, that's going to buy you a lot of different stuff than what it is going to buy you in 2022. And you need to understand that the value of your cash is getting eroded, which is causing an opportunity cost. Which could you structure that a little bit better? So instead of, for me personally, throughout my whole investing career, if I think back to the fact that I've never had anyone call me up saying that they're so happy that they sold a property, whether it be someone that I've bought for, most of the time it's people coming to me saying, because when they come to me, they're not like, hey, I'm selling my properties off, they're building that asset base up and they're trying to add more assets to their portfolio. But when people come to me and they're like, I sold a property beforehand, they're not happy that they sold that property. So, looking at the fact, if you're buying, actively trading properties, making a bit of cash, you could be missing out on buying the right properties and the right assets for your foundation portfolio, and the time would pass you by that in 2, 3, 4 years' time, after you've done all these transactions, you have no assets, you've got some money that doesn't really buy you anything, and you can't go and buy the assets that you could have today that would have got you to retirement. So I see so many people, I think back to all the people that I've spoken to in the last 10 years, just the last 10 years in business, and thinking, okay, what happened to every person that I've ever had a communication with? What happened to every viewer or listener to my videos and YouTube and podcasts out there? What happened to their situation? What would their life be like if they had have taken an action? What change could they have made in their portfolio that would have got them retired and not being retired today? So these are very, very important questions, and to think about, what ifs, potentiallys, maybes. I hear, just here in the start of 2022, next week's podcast, we're going to be doing lots of questions from the community, and just looking at the questions that have been coming through. People are thinking, what happens if interest rates rise? What no one's asked is, what happens if interest rates fall, right? And, if interest rates were to go up for a year even, or 2 years, right? Would that mean that they'd start forever? Or would that mean that if they were to go up, which I'm not saying they are, and I actually think the opposite, and I'll be talking about that and covering it off in future episodes, but if interest rates were to go up, what about when the reverse happens and they come all the way back down? So we need to be looking at, the bigger picture. It's always about the bigger picture, and you want to be minimizing risk, looking for the most amount of options for yourself. Whenever I'm making a decision, I'm always thinking about the amount of options. If I was in my job today, I was going to quit my job in the next 2, 3 years, or even this year, or whenever the case may be, I'd be looking at my finance and making sure I've got a damn good finance strategy in place to be able to tap in all that equity and be able to, not have more options when I'm not working, because if you weren't working, you wouldn't be able to get a loan. So think about 2 years, 3 years, 5 years, 10 years, 20 years down the track, And is this decision going to be helping you in that position in the future, or it's going to just help you with something today? Personally, I believe in the next 10 years, we won't even be using money the way that we're using it, right? And I've talked about it extensively over the years, but if we're not using money as we are today, it's just going to be an old relic and a worthless piece of trashy paper. So money has no value to me. The actual asset is what has value to me. So think about it more multidimensional. If you need help with your strategy, you can reach out to my team, 1300 367 925. Send them an email at admin@B.Invested.com.au. My team of investor relation managers, they help with all my investors, and there's a wealth of knowledge there with my team, and I'll actually be getting them on sometime soon to answer questions from the community as well. So on that note, guys, thanks a lot for listening. Make sure that you share, you like, and subscribe, and give us a thumbs up if you like what you see, and we'll catch up soon. Have an awesome week. Bye for now.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it. The dollar back to die, soon to be hyperinflated. This my 2 cents, don't care if you save it. Joint be decentralized and you will see you be lied to the whole time, and it's the irony, cause they do the exact opposite. You become a slave to the system, enough your money, all they do is profit. There's no conspiracy theory, you better hear me. Crypto will set you free before the system does. I don't care if you do or you don't, but what I'm saying is the truth to the reason you choke. I've never been a failure, excuse my behavior. Keep talking, haters doing me a favor. They all tell lies, I know what they been telling you. I'm the opposite, the Donald Trump of Australia. It's amazing, here for the taking, my time is never wasted.